Hello everybody, Brian here from quantlabs.net. I just wanted to let you know for today on November 28th, I have reactivated two scripts that are very useful for analyzing the US markets, specifically at the Fed and economy level. So in here on my membership on the quant analytics stuff, I'll be pumping these out regularly, and I'm just going to give you a general walkthrough. I've gone through this numerous times, but I think it's very important that people get up to speed on this because it helps in both their forex trading if they're tracking the US dollar, and overall some of the things that will impact the US dollar. I mean, outside of trying to look at it, because charts won't tell you this, but if you are able to interpret these data sets as well as the charts, these will give you a much better explanation of why certain currencies are not as strong as they should be, or they are stronger, and so on and so forth. So let's take a look. So here I have this thing called U.S. government FRED, which is from the Fed, St. Louis Fed. I've got videos on this. This is dated for today, 11/28. So if you go over and you have access through, by being a member, you can download this chart. So when you download the chart, you have the ability to basically see all the data that's pumped out. So I'm going to walk you through this. I've done various videos on this before on my YouTube. I'm going to do it again just to bring everybody that's new up to speed and how critical it is to understand this stuff. So if you go under my channel and you just do a search for Fed, what you'll find here is all my reports and similar things on this. Really important to understand that. I don't put this stuff out for the fun of it. I take this stuff very seriously, and it shows how serious this stuff can be. Okay, so there's the Fed. Another good search topic here is the FRED as well. So you can definitely, okay, there's only 3 videos here, but you get all the same information I'm going to show you now. This is for today, November 28th. Okay, so knowing what we know, as I said, I'm going to walk you through this. Now, these are going to save you a ton of time. It's one of the big benefits I have for my membership. So let's say if you want to go to St. Louis Fed, let's say US Fed, and then there's FRED. This is better. So in the St. Louis Fed here, you get some data series of, I don't know, percent change preceding. There's a ton of data you can work with. 10-year Treasury constant maturity rate. So we do monthly. Here's the chart for it all the way back to when it started as 2013. And then you can get access to the raw data and download the data, okay? So what my script will do is it will download the data and then chart it automatically for you. But we only do a certain number of data sets because those are the important and critical ones. So as I said, I'm gonna walk you through it. Here's the data set for this. If you want to ever load it up in your spreadsheet like Excel, in my case LibreOffice, and then import it. And basically what the Fed does is it will give you the date, the data number, and percent of change. Each one's different. The reporting frequency is different. It can be quarterly, monthly, maybe daily. It depends what you want. But here you can see it's every week. Okay. So knowing that, we can check out the chart. And again, these are for just general eyeballing, but I've already done my analysis when the last recording session crashed, so I'm going to do it again. But the key here is to understand that I like to see it all the way far back as I can, that the Fed has been collecting this info. You can see classic business cycles here. So this is the claims uninsured unemployment. So you can see it peaked in 08, 09, and then it just dropped. So historically, it's not quite there as in the early 70s, but it is definitely lowest since roughly early 70s. Okay, so then we get into the manufacturing, different sectors. Now this is key if you want to use remember, this is all forward-looking data. Very important to understand that. And usually this data comes from, which is forward-looking, the outlook of how they look at maybe the next week, or next month or quarter, depending upon the frequency of how this is collected. But here you can see the run-ups of the outlook, and in 07, they don't feel too comfortable with the outlook, and it just crashes. Like in 07, 08, and it comes up, just peaked for some reason here, I don't know why, and it's coming back since 14. And again, you could break this down by each week. Okay, so that's hard, durable goods. The other thing here is the GDP, gross domestic product. Here it's been steadily growing. Good. These are good signs. No dip here. 08, 09. Now again, we can break down the manufacturing by type. In this case, it's industrial production. Usually the big ones are cars and airplanes. So companies like Ford, let's say Boeing, you can track their performance based upon this. So you can see here, it's been a steady increase since the 40s to 2000, drops off in roughly 709, comes back, and it's been flatlined but has not grown since. This is the struggles that the government, the U.S. federal government's been going through. But I'll put together another video on this whole, what I think the future will look, which is important, knowing what I think will happen. But I'll make a video on that. So this is industrial production. And again, that's business. So you can use that by sector, as I said, planes and cars. Now remember, in the world of equity, you have the sectors, but you also have, are they defensives or are they cyclicals? So with the economy the way it is now, which is doing quite well, that's a cyclical. So when the economy turns, then the defensives will start to outperform. Not great, but they'll definitely outperform the cyclicals. And those are usually military spending under Republican, like Trump, or healthcare, which has been doing fairly well. Also utilities and whatnot. Those are the defensives. So again, we have industrial production, business equipment, drops off, steadily incline, or increase, run up, goes back down, run up. But usually you can see here, the last downturn, it went up and exceeded the last peak. Here it's not, it's just flatline. And I think these are, again, these struggles that the U.S. government's facing because of globalization and the exporting is there, but it's just more imports than exports. And again, you can factor in your charting and with the data, on forward-looking data, on how you feel about investing in these type of sectors. Here, let's see what this one is. This is consumer goods, cosmetic, Procter & Gamble comes to mind, those kind of companies. So you can see if you invest in these companies here at this low, and you would have done somewhat well, because their performance in the stock is generated by their performance on their what they're producing and how much they're producing. So you can see here's a run up, and again, it has not exceeded the historical peaks when there is a drop off. Every single decline here, you can see that this is from the 50s, that has suddenly run up and then boom, it hits a plateau, and it has not broken through that plateau from the early late 90s, let's say. And that's for consumer goods. And again, it's really important, if you took this from a portfolio standpoint, it's really to understand, like, why would you put money and capital into these kind of companies? Because the growth is not there. I mean, when you look at companies like Facebook, Apple, Amazon, you're getting a much faster, higher rate of return in a short period of time. Whereas you put your money into these conservative manufacturing type of players, your capital's sort of tied up there, and you're getting very little return, very little performance. So that's something you need to consider when it comes to your portfolio. But again, it depends on your risk profile as well. So here, I believe this is another production one. Production. But this one's a little better from the early 70s. Steady run up till about 2007. Hit the peak, drops off in 08, 09, and then guess what? Never comes back. Has plateaued since 2011, but again, never breaks through. And that's what the government, the U.S. government, no matter who it is running the show, Republican, Democrat, doesn't matter. These plateaus are pretty well killing off the U.S. performance from a global perspective. More charts. And again, this is raw data from the Fed, so this stuff doesn't lie. So no matter what you read, this is how you interpret it from raw, forward-looking data. And when I'll make another video on it, and you'll see why it's really critical to understand this. You can see here, production material. This is the odd one, a run-up, boom, 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 boom. But guess what? We've talked about with the other type of manufacturing, it never breaks through the peak of, let's say, 2007. Well, guess what? For materials, it does, as you can see here, and it may continue to grow. So this is, if you're going to invest into industrial companies, you want to focus on the materials sector. And you can easily find those through Yahoo Finance for those type of sectors. So again, this is a decent outperforming sector. Okay, that's why they get mentioned a lot more than on Bloomberg than any of the other sectors we're talking about. Again, mining, a nice sunrise is really cool. Maybe the odd, but I think the U.S. has extracted what they can get out of their domestic mines. Here it's slowly dropped off under Trump, under Obama, boom. Here, promise of helping the coal miners, boom. It's not going to do much. Here's another chart. So this is a different data source from Quandl. So manufacturing custom inventory index. All right, so here, this is the key. I got to show you the data. Very important. Now, this goes out to a manufacturing association. Okay. So really what you want to focus on is the net. So it's like, how do you feel about the economy? Too high, about right, too low? Here's the net effect. This one's the one you want to watch, the net. Okay. And the chart on that particular line you want to watch is this one right here, the cyan one. So you can see here it's peaked in 07 and it's slowly increasing a little bit. Nothing to brag about overall on the manufacturing level. Again, why have your money tied up in those type of companies on the stock front? That's why there's no performance. So again, this is imports. Again, it's just been flatlining since roughly 08, just no growth. Inventories, again, this is a key one here. When you're looking for that blue line, that's cyan, 08, 09. I mean, this is kind of a good sign where their inventories are being drawn down because, well, manufacturing dropped off. So the production and consumption of those products work off the inventory, which happened, and then just peaked back, and it just stabilizes. So inventory is very important to watch as a forward indicator to see and confirm when you're into a recession, because your inventory will start to decline, or your inventory starts to go up suddenly, and that means the economy's slowed down, but they're not selling what they're producing, and therefore inventory goes up. Or in this case, in 07, 09, manufacturing pretty well stopped, and they just drew down that inventory that was left over until things started to pick up again on the manufacturing front. And you can see it slightly, historically, went up a little bit, slightly declined, and then stabilized, as what you would expect. The other one, exports. Now this is an important one because of the trade balance. Now this is what drives the performance of the US dollar, which nobody really factors in. So when you look at this time period when the US dollar was fairly weak, obviously, international companies will look to the U.S. to import that product into their economies through trading, and basically, because that's a weaker dollar and they want U.S. product, they will import more if the U.S. dollar's low, or the economies in those countries are strong enough where they feel that they will go out and import more because their domestic manufacturing has improved and is stable and is growing. Or if it drops off like this means that the economy is starting to slow down. Global trade, and there's lots of indicators you can look at through tradingeconomics.com on that, and other websites that give you what are the big industry exports coming out of the States, and usually it's planes and Ford automobiles that drives that. Well, historically that is. Okay, here's another one. New orders, another important one. Here you'll see 09 drops off, as you would expect. The orders drop off because manufacturing, as I said, with the inventory stops for a few years, and it comes back and it peaks, and then it just slowly declines. But guess what? It's hit that peak again because of the confidence and people buying, and companies import more manufacturing, classic economic stuff, but it's slowly coming. Getting drawn down. A great indicator to watch to see how the economy outlook is. New orders. Again, we're back at the Fed as a data source. This chart's quite interesting because you can see since the 90s. Now here I want you to understand this is non-defense, because let's say if there's a recession or during a war, obviously new orders will be skewed, really. So that's the government putting those orders in. If there's, let's say, World War II, we need military equipment, whatnot, so the manufacturing of those products will go up. That's why they factor out non-defense. So these are more private sector stuff, like normal economic conditions. So you can see the business cycles here again. Now, here isn't the interesting part for the last, since the early 90s. It's just the standard rise, decline, but you can see here on the capital good expenditure, and also excluding aircraft, because aircraft is such a huge export and huge part of the U.S. economy, so they factor that out as well. So here, this run up and then this decline in the early 2000s, let's say, was a dot net boom, the internet bubble. So that dropped here, it ran up, recovered again up to 2007, financial crisis, real estate crash, boom. But the magnitude of these drops are the same. But here's the interesting part. It's just plateaued, and then we are going to, historically, some cyclical, have another drop. So we'll see where that goes. But again, good indicators. So when you start to see your new orders drop, if you get like a couple of months, see how frequent this stuff is. If you see a couple of negative periods of no new orders where it drops off, then guess what? That's possibly a classic indicator of a recession coming on. So here we've got this is a monthly report. You can see here it's increased. It's been choppy. Let's see a sudden drop here in May 2016. But again, if you see a number of negative drops, then it's a sign that things are definitely slowing down in the economy. And again, these are forward-looking because these are new orders going into the economy. As of today, we have all this product that we want to manufacture over the next month, next quarter. So it's a very powerful forward indicator. Let's see what else we got here. Non-farm payroll. Again, they take out the non-farm. Now, this is important because this is what drives people's sentiment. And you can see that they have added marginal employment. Now, I have talked about this in my previous session, But let me repeat this. The federal government, as you can tell in other data sets, some of those data sets go back to the 20s. Now, the reason this has been reset, I really think, I'm going to be honest here, this is no conspiracy theory BS. This is truth. Because they have and always have collected this data since the 20s. But because of the grinding down of these numbers, of the number of people that are employed every month, it's been so dismal that the Fed and pretty well the government's trying to make themselves look good by just, well, let's stop no longer collected or don't show the history of it and try to make ourselves look good. So when you look at this chart, yeah, they look good, but the marginal increases each month is very tiny. But meanwhile, when you look at the other charts I've shown you, the manufacturing is and whatnot is quite big, like you can see here. So we're going back to here, but these run-ups are much stronger before the 2000s of that last data set. This one's a good one for housing, construction of housing. Another classic example of sectors that you can analyze. So these are private housing, so residential really, number that have building permits. So again, these are the number of permits issued moving forward. So this tells you if you're here and they're increasing the number of building permits, what do you think is going to happen to those stocks, specifically in companies building homes or stocks or that sector, or companies that the suppliers like lumber, retailers is another example, like Home Depot. The performance of those stocks will start to rise up until about here. So you can use these building permits as an indicator for those particular sectors in the market for shares. And again, this is all forward-looking, and that's what the pros use, is only forward-looking. Analysts rarely care about what happened yesterday in these kind of data sets. So you can see here, the historical cycles has been the booms and the drop-offs, but just before here, you could see that there was something coming based upon the drop-off. And the reason why this was suddenly dropped off, because real estate was getting more and more expensive. People were complaining more. They can't afford a house in the States, so there's less demand, and over time there was a sudden drop-off in the number of new homes being built. You can see that. So here you can see that they're trying to bring it back, and it's kind of come back, but not to the historical levels that you would kind of expect. Very good chart for that, for residential homes. Now, this is the popular one. Now, this is another one of those charts you need to be aware of. PMI. See here, because the Fed, they reset this since 2007, because historically it looked good, and you get all the numbers way up here historically, but because the Fed's trying to make themselves look good, they're trying to make the government performance and economic look good, they reset the data set, stopped, and they only allow you to see the data starting in 2007, just before that drop. See the stability. Yes, the economy's stable. No, it's not. If you saw the data of the PMI before 2007, I can guarantee you would quickly see the dismal performance over the last 10 years versus historical since let's say the 20s. And again, that is why this happens, and these are why these data sets get reset at 2007. Okay, so there's this one. University Consumer Sentiment, this is the popular one. So 90s, it peaked, late 90s under Clinton. Along comes Bush, kills off that sentiment. In comes Obama in 2008, the sentiment rises again. And it's all based upon unemployment, based upon people's wages. You can see here in 2006, people were again complaining about prices of real estate was too much. They're not buying, they don't feel good about the future, so what happens? The economy drops, or the consumer sentiment drops. It's been slowly coming back, and it's back to its 2007 levels. So that's good, but you got to make sure you don't get too complacent here. Okay, unemployment rate. So these are the unemployment rate. Again, you can see historical lows up since the 60s, but even in the late 40s, early 50s after World War II, it was lower, but considering that's pretty good. But again, I don't know what to believe coming out of the Fed. But historically, it has dropped off, but the pay has not kept up the pace. So let me finish here. These are the charts that you get on a frequent basis, as I showed, available through my Quant Analytics service. I'll try to run these frequently and collect the data and send it off at both levels of what I just showed. Hopefully this will help you out. Hey everybody, welcome to the second part. These charts I'm about to show you have not been collected through my service. I could easily do it, but I just want to show you what's really going on in the markets and historical. And this is a typical snapshot of the U.S. government, where it's going, and I'm going to show you some historical things that may kind of surprise you. Okay, so in the previous video I talked about where to get this data. So you can easily get this through your Google or whatever through doing a St. Louis Fed. I just call it Fred. And what you do is you're going to come to this website here at stlouisfed.org, and it's Fred. So this is the data sets that you get access to. Stuff that I've already shown you, but because you get it and just download it, take a look at it, it'll save you a ton of time. But there's other data sets here that are important. But I wanted to show you what I think is very important to be aware of. So if I go back to Google and I do that same search, St. Louis Fed. So we're going to look at the Treasury, the U.S. Treasury, the bonds of the U.S. government. So usually a 10 years is a good one to work off. It's a standard, global standard. Okay, so here's the daily moves of the federal Fed, which is fine. That is for a 10-year maturity. Okay, so what I'm going to do is I'm going to go back as far as I can, and so we're going to go back to 1962. So let's see if we can do a new chart. Okay, so let me just make sure I'm getting this correct. They have changed things since I've looked at this. So we want, no, okay, let me do this again. Treasury bill, Federal Reserve economic data. I think I came under through here. So we want 10-year Treasury. Let's say, okay, so we want max. Yes, this is what I wanted. Okay, so starting tracking in the early 60s, you can see that the U.S. Treasury was paying around 4%. Again, peaked at 15 in the early 80s. That killed off a lot of people on their mortgages. But from a savings point of view, this was critical. And it helps the government fund themselves on all their programs. But what I want to show you, there's a sudden run-up, and there's been just an overall decline here, and it's at 2.5%, okay, which is fine, and that's a 10-year. So when you have a longer maturity of, let's say, 25, maybe 50 years that they're starting to roll out in Europe, even 100, these maturities or yield is still around 2%. The reason they're doing the more longer term maturities is because they know if you looked at Germany or anywhere in Europe, these interest rates are negative. They never saw that. But let's take a look at a more short term one. So if I want to look at the 1 year, let's see if I can go back to the 1965, let's say. Sure, if I can do this. So go 1965, 12, let's say. So, not sure. This is again the 10-year. Want the 1 year. I don't think we can do it. Okay, so let's see if we can do this. And then to there, edit graph. Okay, so basically what we're doing is we're seeing that the interest rates are very low. And the overall chart here has just been grinding it very, very badly. Okay, so this is important for people to understand. When you have this peak, goes in this sudden decline, and you're hitting 1.83 lows or 1.57. That is dangerous, because once these interest rates start to drop and they start to approach zero, and then they start to go into basically a deceleration mode, a de-inflationary. And when you look at some of the charts that I've already shown in the 30s, how it's dangerous for the interest rates to be that low, because generally the government cannot fund itself, so they have to start cutting back on all these programs like pension, Medicare, whatever else, even military and whatnot. And I've shown chart after chart that shows the history of this. So what does this mean? Where does this go? So if we're at 2-point-something%, the government is literally desperate trying to bump up this interest rate so that they have enough of a buffer of an interest rate when the economy turns, which it will. It's cyclical. Historically, it has to drop, go into recession mode. The government needs enough firepower on the interest front so it will continue to be able to fund itself in those time periods. And if they don't have enough firepower, they will not be able to sustain the programs unless they want to run deficits and debt. But we'll take a look at that in a minute. So once this crosses zero, I really think people, especially the ones that finance and buy up these treasury bonds, are going to lose confidence in the U.S., which basically means this is supposed to be the last bastion as a financial security, because it's the U.S. and the U.S. always pays its debt, always honors its bills. But we're seeing that is going to be a stretch. So once it hits zero and you go into that deceleration or disinflationary mode, what will happen is things will become cheaper. People will not consume because they know, if I want to buy, let's say, a widget or let's say a hamburger today, chances are tomorrow it's going to drop. So I'll delay that purchase. So the economic activity drops off because people know that tomorrow, next week, the price for whatever they're going to buy is going to be cheaper next week. And that means then, well, if companies are supposed to employ people and make things under those conditions, guess what? They're not going to do that anymore. And that is where the economic conditions are very bad. And as a result, people will be laid off and da-da-da-da. And we're not even factoring in, this is just traditional manufacturing, traditional jobs. And that does not include globalization, does not include, as robots come in and automation in the world, that it could get pretty ugly. And as the deflationary conditions come in, guess what? It's going to be very difficult, and over time, at some point, like in 1929, people will lose confidence in the capitalistic system, and that's what caused the Great Depression in the early 30s. So I'm going to talk about that in a minute. So the first thing that we need to understand is, another thing that we need to also understand here is when you look at these maturities of up to 10 years, governments are now starting to extend those maturities out to 25 years, 50 years, 100 years, because they're getting so desperate to be able to fund themselves through these long bonds and paying like measly yield rates of like 2%, and very few people are buying them up. You can see that on the Bloomberg. And that's why they're predicting in the next 2 to 3 years, there will be a massive bond crash. And when these bonds crash, guess what? The economies, especially the governments, are not going to be able to fund themselves because people aren't buying up the debt. And they lose confidence in the debt. So let's take a look at that. So if you come back into, let's say, the Google thing, all the kids call it a Google thing. So if you do St. Louis Fed Fund, but you look at the U.S. deficit or debt, well, let's look at the debt first. Federal public debt. Boom, boom, boom. Now again, I don't make these numbers up. This is not lying. These are raw data. So you can see here, 80. We're at just under 900 billion. Climbs up. Boom, 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 boom. Now imagine here. This time, this is when the U.S. government came off the gold standard. They wanted to float their own currency. And look what's happened. They've added a debt. So around here in 2008, 7, $9 trillion debt. That's pretty high. As soon as the financial crisis comes in under Obama, look what happens. It goes from this, $9 trillion, to over $20 trillion. So imagine this is the debt you're taking on as a government or the Federal Reserve. Now remember, the Federal Reserve is not part of the U.S. government. Okay, it's private. It's not, and it's funded by the banks. The banks love these. They make money one way or another. It has nothing to do with the government. But Federal Reserve is a private company, and it's the Federal Reserve that funds the U.S. government. So now you're at $20 trillion frickin' dollars. And it was at $9 trillion in 2008, and now it's at $20 trillion. Congratulations, Mr. Obama. You doubled it in 10 years. And when you get into the political, under those Democrats, they like to spend their money and do whatever they can to get back into government. And here you go. Like living proof. So there's that. So another thing you can look at is the overall surplus and deficit. This is the sad part of any government. If the government was a private company, the U.S. government would be bankrupt by 1943, or even starting here, because this is your profit, this level above the zero line, and you're running everything at negative. Now I can see why this period is negative, because, well, here you're running at surpluses, complacency, 1929. Boom! 1929 hits, guess what? You're in a surplus now. All of a sudden, you're in Great Depression in 31, and you're starting to run little deficits, right? But it recovers in 2000 and 1938. Another big problem came along was Hitler in World War II. Boom, right? Got hit. But they had an economic boom time, and it bounced around at the zero line, which is all fine, because the government's not in the business to make money. Okay, let's get that straight. They generate taxes to fund these deficits. That's why they tax. So here, you can see it's fairly stable until what time? 1974. Between this period here, this is what we call the Saudi Arabia oil embargo. They're not going to allow the U.S. government to import oil. And deficits for how many years? From 74 to 19. So you got 23 years of running a deficit. Okay? Not good. And that's why the debt was so low up until here. So if we look at the debt, it was fairly stable. It was very manageable right around here. At what point did it start to skyrocket? Well, a little bit. But it took off around 2008. Okay? This is why the U.S. government and the U.S. economy is in big, deep, whoop trouble. Okay? Because here, for 23 years, they're running a deficit. Along comes Obama or Clinton, kind of saved the day for a little while during this period and did some good things, no doubt, and got the economy back into a strong economic condition. Along comes Bush, and we're back into the deficit spending mode again. Governments cannot operate this way. The only way they can fund themselves is through either one of two ways. Treasury buying up the debt, or raising taxes. You tell me. You can see here, guess what? If people are buying up the U.S. debt, that means there's people out there wanting to get paid on the interest on that debt that they're buying up, the bonds, right? So here, as that debt grows, okay, on top of that, we're not even factoring the freaking interest of that the U.S. government's got to pay out, which you never hear about. That this, I don't know the exact amount that the U.S. federal interest service debt. Let's check it out. So I don't know where to get this information. U.S. Service debt service cost. Maybe there's a chart. Maybe there's a chart. Let's see, St. Louis Fed. Now, I would think that the Fed would track this, wouldn't you? Household debt, we don't care about that. Consumer debt, we don't care about that. We care about federal current expenditures, interest payments. Boom, there we go. Okay, let's check it out. Ooh, Nelly. So you can see here that this is now, let me repeat this. This is billions of frickin' dollars. Okay, so here you're now paying $400 billion, $430 billion is being paid out in interest rates, and it's growing. Boom. 512 right there. Okay, so that's not a good thing, wouldn't you think? Right? So this is what's going on right now. The government, U.S. government's basically either going to have to raise tax, and that ain't going to be happening because Mr. Trump wants to cut tax, not raise it. So what's going to happen? Who's going to pay for this debt? How's it going to get paid? How are they going to fund themselves? He's banking on that the economy will explode with economic activity. I'm not so sure if that's really going to happen, but nice to think about it. But yeah, that's where we're at, right? So people have to pay off that debt. So what's going to happen? Well, as I said, we got a big tax plan. I think they have to do it, but I don't think it'll work. So we've already identified how much the federal government is paying in interest payments. Just over $500 billion. That's quarterly. Wow. So they're actually paying in interest rates. Let's see. Let's see if we can find 2016. Better yet, let's download the data. Okay. Very exciting, isn't it? So this is going to be, let me lose a better, oh, this is good. Okay, so we have here for 2000, these four numbers we want. Okay. Let me pull up my other spreadsheet here, the proper one. Oh. Spreadsheet. Okay. So we go some no, okay, whatever. We'll do it manually. Let's see, calc. Well, let's not even do that. Where's our numbers? So, okay, where's my numbers? There we go. Okay, so you're looking at, let's say, $2 trillion roughly for the, so $2 trillion, okay, $2 trillion freaking dollars is being paid out in debt for 2016, okay? That's just roughly, okay? So if you look at the U.S. federal budget, where they're spending their money, which I don't think they would include interest rates, or they'll probably bury it as a different 2016. So let's see. Under Wikipedia, is this doable? No. U.S. federal budget 2016. Okay, what is the total federal budget? What percent is spent on defense, federal, and infograph? Let's see, this is from the CBO. This is government issued. Okay, here we go. So here's the revenue. Yeah, we know that they're going to be at a loss with the deficit. We've tracked that. So here we go. So their total. Let me get this straight. You have 3.9 trillion spent. Medicaid. So, wow. Between Medicaid and Medicare, the servicing of the debt is double of that. Social Security, again. So the total service of the debt is Social Security, Medicare, and Medicaid. Wow. Defense and non-defense. Wow. So other unemployment, compensation, federal, civilian, military retirement, and veterans. Oh man. Oh man. Okay, so let's go back to our little numbers here. So we figured, and again, I find that really astonishing that these guys have not included, maybe they do, maybe they don't, I don't know. Let's see if they talk about the interest rate that they're paying out to service the debt. Net interest consists of the government's interest payments on debt held on by public income, federal. So here you go. So maybe they do talk. 40% debt held by public as a percentage of GDP. So 40% of their debt, of their GDP, goes to debt. Wow. So they do talk about this. But if I'm going to take this correctly, to service the debt that they have, which from what I'm gathering here, now I could be mistaken. Where's my spreadsheet? For this little guy right here, which is by quarterly. These are total in billions of dollars that they pay out roughly in the service of debt. But yet, they say they spend $4 trillion. So half. So this is what they're spending, plus another 50% of this is for servicing their debt. So you can see why the U.S. is somewhat in a big doo-doo of, I don't know what we'd call it. But this is from the Fed, man. I mean, these are no lies. And $2 trillion of it goes to paying out those debt holders. So who owns that debt? Let's see. Okay, who owns USA debt, which is through the bonds? Here we go. Here's I guess an infograph. So who owns? So Americans own half the debt. China owns $1 trillion. Japan owns another $1 trillion, and $3.8 trillion owned by other countries. So roughly about $6-7 trillion is owned by foreigners, and then there's going to be probably private debt holders. And as this continues, this is not a good sign because it's unsustainable. It's just basically the math of it. Anyways, let's go back to something else. So if we go to our Google and look up something called debt GDP ratio, and I'll show other countries as well, just to show you comparable. So we see the reasons why the debt to GDP is going to be exceptionally high. So this is according to our friends over at Trading Economics. Now, let's see. 92.3 for 2016. Not good, man. Okay, so let's see. What is Greece? Greece debt to GDP, right? So you can see here, apples to apples comparison with trading economics here. Wow, 179%. That ratio is way high for Greece. And we know about Greece with the depression that they're in, and just virtually they've overspent with little taxation, no productivity, no economic activity in their country. They had to get bailouts from Germany and other European countries. But you can see here they're just not looking pretty. So here problems started back in 2007 at 100, broke through, and it just went crazy. So what was the U.S. again at 92.3? And where did the problem start with Greece? Just in 2007, 2008, and we know where things are comparable to Greece. So if we were to forward, to see how things may look 10 years from now with the States, when you have this debt ratio at 92.3 and just 10 billion off, you can start to see what things will look like in the States. Just Google it and see what things look like in the States. So that's fine. Now, let's look at other countries. I'm in Canada. How do we look? That debt to GDP. Let's check it out. I'm not going to get politics with our dear leader, Mr. Trudeau. Guess what? Thanks to him, it's just, let's put it this way, it's jumped up quite a bit. Okay, so again, how do we compare to the U.S.? So we're at 92.3, and how do we compare to the U.S.? Let me just go back to always compare it to the USA. Again, we're just going to use tradingeconomics.com as a comparison. Okay, so the States are at 106.3. Okay, so they've broken through. They're starting to run out of money. Okay, Canada, 92.3. We're not far behind them. Okay, not good. Let's take a look, check out some other Western countries. UK, how's that looking? How's that looking, UK? Boom, 89.3. So they've somewhat stabilized. I wonder if that has anything to do with the conservative government under Cameron and now Theresa May. And when you look at historically, again, we're going to do some politics here. Okay, so I will give you Canada's lesson. Up until here, we were under conservative power. So it was in control. As soon as our dear leader, Mr. Trudeau, comes along, it's now jumped 10% for the last 2 years, and he's been running what we call a hellhole in Canada. It's now jumped over another 10%. So, yeah, I find that quite odd with the UK, where it's controlled at around 80. It's still not good, but as soon as a liberal government comes along, it just jumps up. So let's check that out under the Obama. So I don't think we can do the States, but again, it's just something to note that under a liberal government, democratic government, you can expect that debt to GDP ratio to jump up. So we've looked at the UK. Now you think, who's a good one? Germany? Let's check it out. Germany. Look at what they've done. The miracles under Merkel. It's like I don't know if she's a liberal or a Democrat, but that's quite controlled. And what they've done, and they run at a surplus. So the place to be, the ones that will take over, will probably be Germany, because their debt to GDP ratio is much lower now and it's under control. It's back to where it was 10 years ago. What would be another one? The one that would really surprise me is Sweden. With the amount of problems. But look at that. I mean, they can afford to take on their the migrants that they have. It's jumped up. It's only at 40%. So they're fairly wealthy. Well, let's check out Japan. Okay, Japan. They're pretty well high. 250. but they're so wealthy, they have enough a diverse economy and manufacturing, they can handle it. But this is kind of scary. If their manufacturing base was hit, they would be in a load of trouble. China. Let's check out China. I'm sure it was good up to a point. Now, I know we're looking at Eastern Asian countries. Oops. So let's check it out. China. Very low. Very low like Japan. So it's very manageable. I know. Let's look at a country, small country like Switzerland. Wow, it's very, very low. This is why a country like Switzerland is very wealthy. Okay, Australia. And how's Australia looking? Still manageable. Quite interesting. And Canada, Australia. Okay, let's look at New Zealand. I'm sure there's gonna be countries that I forget. Look at this, how low that is. That is nothing. They probably have a fairly high standard of living in New Zealand. And let's check out probably like a basket case like France. 96%. So once you start hitting around 100, you better be scared, because the governments are not going to be able to afford what you're used to. We just looked at the U.S. as a great example. What else? Let's take a look at a country like, I don't know, Brazil or some South American countries. Brazil. Yeah, that's pretty high for, well, it's not high, but yeah, or better yet, let's do Venezuela. Comparisons. You know about Venezuela, the problems they have. It's that low, but I guess the economic activities come down so much. That's a sudden drop, but it's just under Chavez. It ratcheted up and then it just crashes and burns. So not only Greece you can look at, but you can use probably Venezuela as another example as well. What other countries can we look at? We've looked at France, China. How about Russia? Yeah, Russia, evil Russia. I think this is where some of the transfer of wealth will happen. If let's say Russia decided to become a democracy or a capitalistic system like China, I really think the transfer of wealth would go to Russia. Just saying, looking at these numbers and how low it is. India maybe. India, are they as have a lot of guess they don't have the productivity like a lot of the Western countries do. And was it trading economics? What is India like? That's pretty reasonable. They've dropped it down, which is good. But we'll leave it at that. Okay, so you can see comparatively how other countries compare. It's a good factor to look at when you're looking at overall debt to GDP performance. But the countries that I mentioned that are kind of deep doo-doo, I would say, are U.S., Canada, UK's pushing it, but looks like Germany's taking itself off from the brink of it. Australia's fairly low, but yeah, the countries I mentioned, U.S., UK, Canada, yeah. So there you go. Just a quick analysis on all that. Hope this will help you out. You enjoyed it. If you're still watching, thanks for watching. Have a good day.